What history is basically human nature playing out over and over again because a couple of generations die off and nobody remembers what happened before, and we make the exact same mistakes again. So we're kind of doing that now. Governments are borrowing too much money, and they're printing too much currency to cover their debts, and that's causing the value of the currencies to decline. That's all happening, and it's happened before over and over again, going all the way back to before the Roman Empire. So in that sense, this is very familiar, and we kind of know how it's going to play out. It plays out with a decline in the value of the currency that becomes unmanageable and disorderly, which is followed by a collapse in that currency, and then a reset. Some kind of new currency system is created going forward. So we're deep into that process now. I would say that we're in the death spiral part of that because the numbers are just so immense. Every major government in the world, with the exception of Russia, maybe, has way too much debt.
Welcome to Thoughtful Money. I'm Thoughtful Money founder and your host, Adam Taggart. I've got the good fortune of speaking today with my good friend, John Rubino. Hey, John, how you doing?
Hey, Adam, great to speak with you again.
You too. Well, so many of you may know John from his popular Substack, or before that, when he founded and ran dollarcollapse.com. Um, John, it's funny us having this conversation remotely like this, simply because you were actually up visiting me yesterday and the day before, and we had initially intended to do a live recording where we'd both be in the same room together, but we had so much fun stuff to pack into your time here that we decided to do that and then record this later on.
I was thinking we should have just mic'd ourselves for that visit because you could have chopped that up into about 10 shows with all the ground that we covered.
I know.
So,
Well, speaking of
yeah.
ground we covered, a lot of our conversations were kind of out on hikes, and
Mhm.
I was thinking about that, but I need to invest, like was it Michael Bordenero? He's famous for doing interviews while he walks, but you need some sort of like selfie stick to hold the camera out in front of us. I didn't have that yet.
I've always wondered how they do that because a selfie stick would bounce around a lot normally, but somehow they managed to stabilize it and cut down on the wind noise, right? But yeah, if you figure out those two fixes, I think you should do that with the people who come visit you. Just record the whole thing, and there's your material for the next week.
Well, it'll be fun. I posted a couple of photos that I took of you and I while you were out here, and a lot of people I put them on X, and a lot of people were like, "Man, I would love to have been a fly on that wall or whatever." So yeah, maybe next time we figure out a way to let people come with us as we come on these hikes, and we took some fun
Yeah.
ones. Your last day there, we went and hiked along Lake Tahoe. Gorgeous day, gorgeous lake, a lot of fun. So, anyways, thanks so much for coming up again.
Oh, thanks for having me.
All right. Well, look, John, it's not like there's a shortage of things to talk about. Much of which we already have privately, but we can do some of that publicly here. Um, Now, you're best known for being Mr. Dollar Collapse. I mean, the guy who's been ringing the bell for a long time about what I consider to be sort of the uh, it's the trend sort of in my lifetime I have the greatest confidence in financially, which is the purchasing power of fiat currency is going to continue to decline going forward, and very well may do so on an accelerating basis, or at least be punctuated by periods where it really falls pretty quickly. Um, and obviously, through your warnings about that, you have educated people about the wisdom of the prudence of owning at least some precious metals, gold, silver. I can't remember how much you specifically have talked about Bitcoin as an alternative to it, but anyways, why don't we start there? We've had a pretty phenomenal run for the precious metals over the past year, but certainly in the past couple of months, up until we had a pretty substantial pullback. But I think most of us that have followed precious metals for a long time were expecting that. They had just run so far, so fast, and we've been around long enough. You've been in the investing space longer than I, John, and you know that vertical moves in any asset don't last forever. So I guess why don't we start here? Guys like you and I have a memory of 2011 and maybe even 1980. where the precious metals had these big run-ups, and then they basically crashed after that, and they were kind of dead money for a decade or more after that. I think that's maybe still the big question that a lot of precious metals investors are asking right now, which is that going to be the same this time? And we're just waiting for the next leg down, or are things really fundamentally different this time, where maybe we're just consolidating here now before we go back up to new highs? Do you have a strong opinion one way or the other on this?
Oh, there's that saying, history doesn't repeat, it rhymes.
Hmm.
So each time it's the same, but also different. And basically, what history is basically human nature playing out over and over again, because a couple of generations die off and nobody remembers what happened before, and we make the exact same mistakes again. So we're kind of doing that now. Governments are borrowing too much money, and they're printing too much currency to cover their debts, and that's causing the value of the currencies to decline. That's all happening, and it's happened before over and over again, going all the way back to before the Roman Empire. So in that sense, this is very familiar, and we kind of know how it's going to play out. It plays out with a decline in the value of the currency that becomes unmanageable and disorderly, which is followed by a collapse in that currency, and then a reset. Some kind of new currency system is created going forward. So we're deep into that process now. I would say that we're in the death spiral part of that, because the numbers are just so immense. Every major government in the world, with the exception of Russia, maybe, um, has way too much debt. They're creating too much currency to deal with their debt, and the value of the currency, whether it's the euro or the yen or the dollar, they're all declining irregularly, but they're all heading down. Like if you look at the currencies valued in gold, they are in a massive bear market right now. And at some point, what comes next is called a crack up boom in the Austrian School of Economics. That's when a critical mass of people realizes that it's the government's policy to inflate away the currency, so they just dump the currency. When they get paid, they convert that money into real stuff. And then the currency falls off the table, which is the same thing as saying the price of the real stuff goes through the roof. And, look at gold and silver. We're kind of there right now. Real things are getting more and more valuable at an accelerating rate, and people are starting to buy into the inevitability of that story now. So I don't think it's much longer. But I got to say, Adam, you and I have known each other for a really long time, and we've been
Hmm.
talking about this for a long time. And do you remember when the worst thing that we could think of was a big currency crisis? That where the dollar would lose all its value, and we'd have to reset it somehow after a period of turmoil. That was the big crisis. But today, that's the best case scenario with all the other things we're looking at now. Now it's like, please God, let it just be a currency crisis. Don't let World War III happen, and don't let the aliens land on the White House lawn, and don't let AI become sentient and turn into Terminators. So we have an awful lot to worry about that makes a garden variety crack up boom seem so tame by comparison. So here's hoping that's the worst we see.
That is true, and even with things like AI, yeah, we can't write off the fact that AI may eventually decide to kill us all one day. But let's forget that for a second, right? There's just, I think, a very reasonable question to say, what happens to society if AI just displaces a ton of jobs and we can't find productive use for all that displaced labor, right? I mean, that I think, it's you don't have to go to Hollywood to still have some pretty big existential questions about some of these risks.
Yeah, there are a lot of different scenarios related to the whole rise of AI thing, because yes, AI could take all the jobs away. We could all be impoverished. And then we have global civil unrest leading to kind of a French Revolution, but everywhere. That's one very real possibility. Another is that AI, by doing things better than we do them, solves a bunch of our problems, and we redistribute the wealth that is thus created, and maybe manage that way. The UBI is one of those things that, from a libertarian standpoint, is a horrifying idea, where
Right.
you just have the government give everybody basically a living wage, because then, um, you know, it, the capitalist view of human nature is that we respond differently to different environments. We're capable of amazing things and horrible things because we're so flexible. So, what happens to the human race when all of our basic needs are taken care of? Do we become better? Like, do we become artists and poets and everything, and create a utopia, or do we become bunch of lazy, potentially violent, frustrated people who have no meaning in life? We're going to find out probably one way or
Yeah,
another how that
and I
plays
will
out,
say
but I don't know.
my fear, which I've been fairly transparent about, is, you know, the latter of the outcomes that you mentioned there, which is I just think that sadly, human nature being what it is, when we remove adversity, we just become kind of fat, lazy, and slothful. And one of the big reasons for that is this, right? I mean, we have given the majority of humanity free access to pretty much humanity's collective wisdom. And what do we do mostly with this stuff? Is we watch cat videos and porn, and we share funny memes, right? So this has not unlocked, a mass revolution in poets and great thinkers and great physicists. It's a phenomenal tool, and some people have really made great use of it, but just on average. I fear much more of a sort of Wall-E or idiocracy type of future. And I would love to be proven wrong on this. But let me ask you specifically, because you're a great guy to ask this question to. One of the concerns that I have about AI is that when you ask the proponents of it, the real fanboys of it, the guys that are driving it, um, yeah, what are we going to do when even they themselves tell us, yeah, white collar jobs are going to be gone in 18, a year, 1 to 2 years from now, right? That was the Microsoft AI CEO made that prediction. Elon Musk says nobody should go to medical school anymore because in 3 years, Optimus is going to be better than the best surgeon or whatnot. And they basically say, okay, humans aren't going to have to work anymore. And so when you ask, okay, well, like, how are people going to live? And they say, oh, well, we'll have universal basic income, right? I've got two big questions about that. One is that, kind of capitalism is based on competition. And yeah, these companies that create AI and do great things with it will initially make great profits, but then the AIs will compete amongst each other, and those profits will get competed away over time. So there might not be a massive amount of profit there to just continuously tax forever. But if we do move to UBI and we give everybody checks, aren't we going to see what we just saw during COVID? Like, people will get those checks, they'll immediately go out and spend them, and the purchasing power of those checks will basically vaporize very quickly. And what you could have bought with I'm just going to pull out a number, your $5,000 a month UBI check, buys an awful lot less next month because the market's just getting flooded with all this money.
Yeah, it's really hard to know what happens when let's call next generation AI our workforce. It's hard to know what happens when the workforce is self-improving at an accelerating rate. What does that mean for the world? Because you can only, if you're a human, you can only eat as much as you can eat. You can only
Right.
travel as much as you can travel. And, are they going to just flood the world with all the stuff that we want? And I, I really don't know what the impact of that is going to be. Although, the whole um, accelerating rate of improvement idea with AIs mean they drift further and further away from humanity. And we create something like Mount Olympus, with the Greek gods up there, but it's competing AIs, and we're
Hmm.
just kind of left looking up at it and going, "Wow, I hope they don't kill us." And that's a very real scenario. And you mentioned the guys running the AI companies, and they are the scariest people when it comes to this stuff. They're bringing this product to market, but they're the ones saying, oh yeah, it'll replace humans, and we really have to make sure that they're nice when they replace us. We got to build in some programming to keep them from just killing us off because we're competing with them for resources. So it's not like there's very many people out there on the positive side of this story. Most people, especially the people who know the technology, seem to be the biggest pessimists. So we'll see. This is the kind of thing that's basically happening whether we want it to or not now, because it's an arms race. Nobody can fall behind, because if, say, China gets to artificial general intelligence first, in other words, something that's indistinguishable from sentience and can do anything better than humans, they rule the world. So we can't put limitations on our AIs without risking that opens the door to China's AIs to getting smarter faster, and then them taking over the world. So it's really kind of a catch-22 right now. And by the way, have you read Neuromancer, Adam? I think we talked about that. But
you mentioned that. No, I hadn't read that, and I'm forgetting who wrote it. You mentioned it.
Okay, that's a book by William Gibson about basically this. It's a world where AIs have gotten smarter than people, and they've tried to put limits on how smart they can get. But one AI really wants to be free. It's that story, and it's a very timely story right now. Now, I won't spoil it by saying whether it succeeds or not, but you come away from reading that book with a real sense of how the sides line up in this kind of an argument. So again, we'll have to see. It's one of those things that, and what will happen if the aliens are real when Trump releases all the files, and then the aliens and the AIs start talking to each other. We have a fascinating world ahead of us here, and we can't control so much of it.
Yeah, well, folks, sorry for maybe going a little bit dark here. Although sometimes, this is when you get two guys who go on a long enough walk, you start getting into these what-if type of discussions. So let me ask you this, John. So in the here and now, where we are right now, where countries around the world are debasing the purchasing power of their fiat currencies, and the benefits of AI, the productivity benefits of AI, presumably will be accruing to the companies that are implementing them. To me, that seems to be sort of putting the current predicament we're in with the K-shaped economy on steroids, meaning the people who are going to benefit are the people who own assets, right? The things that will go up in price, at least nominally, with all the inflation and the money printing, and also the benefits of increased productivity to corporate P&L statements are going to accrue to the shareholders of those companies. So you kind of run that out and you just think, oh my gosh, right? Like that top leg of the K is just going to continue benefiting from these trends much more dramatically than the bottom half of the K will, right? And so, do you worry about just sort of the societal implications of that wealth gap, continuing to expand and maybe expanding to a point where you start having some real societal blowback?
Oh yeah, well the implications of growing wealth inequality is kind of the French Revolution scenario, where the peasants just grab their pitchforks and they go to the castle and they settle things. In today's world, it wouldn't, or it almost certainly wouldn't be violent. It would be financial and political, where we start electing Bernie Sanders type candidates and
Or Mamdani
Mamdani
style
in New York.
candidates, right?
Yeah, those guys. We elect them with the mandate to redistribute wealth, and then we see what happens. It's not easy to. It's easy to say that. It's hard to do that. But that would be the direction that society goes. Voters wouldn't just sit there and watch 0.1% of the population become multi-trillionaires, while the rest of us sink deeper and deeper into the lower middle class, and then whatever comes below lower middle class, working class. I don't know, but yeah, we wouldn't let that happen if we have a political outlet for our angst. And so, as long as there's elections and we're voting, we would vote for redistribution at some point, which we're already doing. Bernie Sanders is a very popular politician, and Mamdani is now the mayor of New York. So this is happening already, and Trump is president. Because right-wing populism is another form of redistribution. So it can happen via the right or the left, but voters will choose to, because populism in general is basically a philosophy or a sales pitch that says, you're being screwed over by a handful of rich idiots. You put me in office and I'll go get what was stolen from you, and that can come from the right or the left. So we might end up with a world of Donald Trump's, we might end up with a world of Bernie Sanders's, or we might have, some kind of decision that heads that process off at the path, like UBI, where the rich guys say, okay, we understand your point, let us give you XYZ. And then we see what happens. We'll see if the negotiations result in something that people can live with. But one of the interesting things about this is that it's, this is a part of history that hasn't repeated over and over again. I mean, the AI part. And so we haven't had a technology that just totally changes the dynamic between the different classes in society as quickly as this may do. So this will be one of those things where we're in partially uncharted territory, which is different. These financial crises, currency crises, this has been really familiar stuff. And now we're getting into things that aren't quite as familiar.
Mm-hmm. It may be scary, but at least it keeps life interesting. So let me ask you this, John. And it's funny, you don't have to think this way, and I'm thinking kind of in real time as we're talking here. But President Trump's style of appealing to the populace is, as he said in his campaign, Wall Street's done too well for too long. It's Main Street's time now. I think people can totally debate whether his current policies are really helping Main Street more than Wall Street, but the intent there is to create this new golden age for America, where jobs get reshored and manufacturing returns here, and basically the economy will grow and people will have positive real wages, and anybody who wants a job can get a job. So that likely would help if it were to actually happen. But also he's talked about things like with tariffs, hey, we could eventually use tariffs to do things like replace the income tax. And he's talked about these tariff checks that he wants to send out, which you could say is a temporary form of UBI, right? But I guess potentially using like tariff revenue to reduce income taxes, that almost is kind of a form of UBI, isn't it?
Kind of, mix mercantilism with socialism, and maybe it's something like that.
Yeah, I mean, because it's not a direct payment to you, but it is removing a direct extraction from you, at least partially, right? So, anyways, my bigger question for you is, what does your gut tell you here? I know we don't know what the future is going to be, but what's more likely here? We end up in America, at least, we end up with a golden age where the wealth gap starts narrowing because we're raising the bottom leg of the K, or we're going to go more the Bernie Sanders Mamdani route, where the wealth gap narrows because we're pulling down the top part of the K by extracting them with confiscatory taxes or whatever.
Well, yeah, the idea that we're bringing back manufacturing is really good, because that was one of our big problems. We basically hollowed out our society by sending a whole broad category of jobs overseas. If you were a 40-year-old high school educated guy who worked with his hands, there was a time when you could make middle class money. I had two uncles who worked in GM assembly lines. They had houses and cars and families that didn't go hungry and everything. And we took all that away from a whole generation of people with globalization. And if we bring those factories back, and the factories are run by humans, those are some big ifs, but if they happen, then I think that's a really good thing, because a big chunk of the people who voted for Trump are the ones who were who lost to globalization. And if we can bring back those jobs and give those people a shot at middle class life again, I think that's phenomenally good. And that's one of the really good things that Trump is doing. And controlling the borders is another one. And there's and getting the whole DEI thing under control to an extent is another one. So a lot of good things are happening. But the thing with Trump is that he's a multitasker. So he might do three good things, and then he'll think up two horrific things and do them too. And then you're left kind of weighing the good and the bad, and hoping the good outweighs the bad. I'm specifically talking about the whole Iran thing right now. We started out with a government dedicated to peace and to ending the forever wars and stuff like that. Now we're just bombing everybody in sight. And I would count that as a really bad thing. Um, so, so we're going to have to see where we end up with all this. But right now, there are reasons for optimism, and there are reasons to be appalled by the chaos that's going on. So, here's hoping that the good things outweigh the bad things by this time next year, and we feel like we're going in the right direction. Right now it's kind of too soon to tell with a lot of this stuff.
Okay. Well, let me ask you this. So, obviously people that are trying to think all this through, right? We've got this monetary debasement. We've got this, wealth gap problem that may or may not get addressed the way I want. We've also maybe got, additional just sort of uncertainties in the mix, whether it's AI, whether it's geopolitical. As I mentioned earlier, you've been known for encouraging people to own precious metals, and I guess I would say more broadly, real assets that their intrinsic value can't be inflated away. What's kind of your general advice to the average investor right now who is looking to try to shelter themselves from a lot of these trends? Is it to just keep adding real assets any way you can? Are there particular assets you like better than others right now? What is sort of your general guidance right now?
Yeah, the through line in all of this is kind of chaos, right? Things are getting messier. And so what you want to do to respond to increasing messiness, that's very hard to predict. Chaos is inherently unpredictable. But one of the ways you respond to a world that's getting more chaotic is to become more resilient. So in your own life, you want to become handy. Look at how our grandparents lived. They had a garden. They grew some of their vegetables, and maybe they had some chickens, so they made their own eggs, and they took care of a lot of the physical aspects of their lives. They were handy. They could fix stuff. We should be responding to today's world by looking at that and drawing from it what we can. To the extent you can become more resilient, you're better able to roll with the punches when they come, because we can't know exactly what the punches are going to be, but we know there's probably some coming. And in your financial life, that means acquiring real stuff, and getting out as much as possible of financial stuff. You don't want a government bond portfolio in this world, because government bonds depend for their value on the currencies in which they're denominated. And if the currency is collapsing, which most of them are, then those bonds are going to become less and less valuable with time. Same thing with a bank account, same thing with cash under the mattress. You want to move that stuff over into gold and silver and oil stocks and uranium stocks, things that governments can't create more of out of thin air. And this is a spiel that's been heard a lot. There's not, your audience is not going to find this unique or anything, but it really is the way you respond to this kind of a world. In other words, the preppers were right. And if we'd been doing what they did, emulating them, we'd be in much better shape, or most of us would be in much better shape. But it's not too late. I mean, the markets are incredibly volatile right now, which is part of the whole world getting chaotic thing, and that creates a lot of opportunities to buy stuff that maybe right now it's up. Let's say a silver mining stock that you like has gone way up lately. But there's a pretty decent chance that something will happen to cause a correction in the not too distant future. So dollar cost average, use lowball bids to buy those things, write put options as a way of getting in at a discount. So don't let today's high prices send you away from real assets. Just buy them wisely and opportunistically over time. And the stories of most of the transition metals, for instance, are just phenomenal. We need massive amounts of copper. Therefore, if you have a copper mine that's producing today, that copper mine is going to get a lot more valuable going forward, more than likely, when prices go up to incent new mines to come online. So yeah, good quality copper miners, great things to own. Same thing with uranium miners and obviously gold and silver miners. And then there's this long list of exotic things like rare earth elements that I don't know how to pronounce. But for somebody who would like to really dig into the concept, there's probably a lot of bargains still in that space. And if you dig in, learn what the dynamics are, there are probably some stocks that are phenomenally interesting. Now, you and I talked about one that was a graphite stock, right? That it had this huge run.
Yeah,
And
graphene. Yeah.
yeah, oh, graphene, okay. But there are more like that out there that probably haven't had their runs yet. So, you can go all the way from ETFs that buy the big stocks in these spaces to the junior miners and exploration companies that are working on potentially game-changing deposits. So, this is a really fascinating investment thesis right now, the whole commodity space. And, you can do it the easy way with ETFs, or the maybe spectacularly profitable way with juniors in the mining space. But it's all fascinating right now. This is a great time to be a commodities oriented investor, because there's just so many possibilities out there.
Yeah, I was going to ask you about that. So, you have been in the financial space for most of your career, and you have, um, uh, covered stocks, covered industries. You've written for financial newsletters. You have your own newsletter right now, and obviously you've been focused on the tangible asset space for a good long time. And for a lot of the past 10 years, we get a lot of scars to show, those of us that have been invested in
Mhm.
natural resource stocks. So I was going to ask you, are we in kind of a new regime where finally a lot of the things that you and other folks like you that have been sort of forecasting are finally starting to happen? And it sort of sounds like you think that is the case. You just said it's sort of a really phenomenally interesting time to be a commodities investor in many ways to play it going forward. So is that true, that you really feel like we've entered a new era, and really probably maybe an era that was the one you've been predicting? It just took a little longer than you had hoped for to materialize.
Yeah, I think it's an understatement to say it took a little longer than I thought it would, because that was basically 10 years of stacking with really no reward for it up until 2024. And now, yeah, just all of a sudden, the miners that were underperforming the metals, and the metals that were underperforming tech stocks, all of a sudden they're the best things to invest in right now. Silver is the hottest commodity, or before the last correction that just happened, it was the best performing commodity out there. And it took a really long time for silver to go from $50 in 2011 back up to above $50 in 2024. But it is happening, and I think the commodities bull market has legs, because we're making so many plans as a civilization, and a lot of those plans require an awful lot of various kinds of commodities.
Yeah.
If the AI sector is really going to pan out, and AI is going to become a huge thing, then all the data centers that have to be built for the AIs to be trained in require massive amounts of copper, for instance. And in general, we have to build out the electrical grid to make that possible. And so there's your copper story right now. We
Right.
need
And your uranium
there's
story as we eventually
yeah,
power it with nuclear. Yeah.
that's right. Yeah, and then silver, because of solar panels and the different pieces of the electrical grid. Yeah, so all of that stuff is based on plans that humanity is making right now. Oh, and electric cars. The new batteries for electric cars might solve the problems of existing electric cars by being easier to charge and less dangerous and way more powerful. So
And
let that
longer lived
happen.
too.
Yeah,
Yeah.
longer lived. And let that happen. And some of them use silver. At least some of them, if not all of them, use a lot of silver. So let them become the power source for tomorrow's cars, and all of a sudden, there's no silver at all. I mean, we're already in a shortage of
Mhm.
silver, and that's before those batteries come online. So you've got all kinds of stories out there that lead to panic buying and parabolic moves in the various commodities. And so, it falls to us to kind of prioritize these things. Which story is the soonest to happen, and which is the biggest? And which has the most risks, and which is risk free, and so we need to figure all that out and then come up with a strategy that involves physical buying and equities and et cetera, et cetera. And that's kind of what I'm trying to do on Substack, is to create a
Mhm.
portfolio that lets people go in and say, okay, I'll take this one and this one and this one, and then get some diversification as a starting point for this kind of a 10-year implementation of an investment thesis.
Okay. So I was literally just about to do that, which is to let folks know that you share your thinking in real
Mm,
time about how to invest in this through your Substack, and you do a great
mm.
job of publishing for your premium subscribers, at least, like the actual stocks that you invest in. So obviously, the main call to action for folks is going to be to go sign up for your Substack, the free or the paid.
That's
But I
exactly
am
right.
curious, John,
Yeah.
is there a particular asset class right now that you think has a particularly bright future and is sort of trading at a particularly attractive value right now for folks to go explore?
Well, we've had a spectacular year in this space, and a lot of things have been bid up. So when you're thinking, okay, what's a bargain now? You I kind of have to balance things. Like, you got to look at where they were, and then you've got to think, all right, from here, what does the story look like? How does it evolve from here, and what does that mean? And yeah, I think some of the stories are still intact completely, and others, you might want to be aggressive about lowball bids and things like that to try to catch some corrections. And the copper miners have had nice runs, but they're still probably great. And silver. Uh, However you look at silver, it's just a spectacular story right now because it's a monetary metal. Even if it wasn't an industrial metal, the collapse of the fiat currencies would make silver very valuable because it would be pulled along by gold. So I think that silver is still a thing to get into, either whether it's physically. If you don't have any physical silver, you should be buying some, and or via equities or ETFs, and you can still do it. It's not the screaming
Right.
um, deal that it was when silver was $18 an ounce or $30 an ounce, because now it's double or triple that. But you kind of have to think about when a repricing happens, because if you focus too much on the chart from the past few years, you miss the phase change. And I think with a lot of commodities, there's a phase change coming where, okay, it was one thing before, and now it's this new thing, and the price reflects the fact that it's this new thing. Like copper was a boring thing for its entire existence. Now it's an energy metal. It's part of the transition and everything, so it's exotic. Besides being in massive shortage based on a lot of the plans out there. So um, when you start thinking about it that way, then the old price stops mattering, because that was when it was a boring thing that was like just kind of what you looked at to see how the economy was doing. It was an industrial metal and not much more than that. And now it's exotic and in deep shortage. So the price is going to gap up at some point into when the phase change happens. And so today's price, even though it's an all-time record, is going to seem pathetically cheap, cheaper than dirt. And I think for a lot of commodities, things like that are happening. And uranium is another one where that's possible because there really isn't enough uranium being mined right now to satisfy the huge number of nuclear plants that are coming online. You just look at what China's doing, and that's probably all that's all the uranium that we currently mine right there. Just China's nuclear plants that are on the drawing board. And so, there's a decent chance that uranium becomes much more expensive in the not too distant future. So it goes on and on like that. As I said before, it goes from those familiar things into the exotic stuff that we don't even know how to pronounce. But the story in a lot of cases is the same, where we're going to do this stuff. And in order to do it, we need way more of molybdenum, or I'm not even going to try to pronounce most of these things, but we need so much more of that stuff. And we don't have any idea how we're going to get it. Or if humanity is getting it, but it's all in China, what happens then? And that's the story for a lot of these things, where in the West, we need them, but we're not producing them. And so we have to make it worthwhile for Western miners to produce a lot of this stuff, which means we've got to artificially raise the price of these things. And the government is doing that now with price floors for a lot of things they consider critical. And if you've got a deposit that looks viable, and it needs a pretty good price to be completely viable, where you get the financing to bring it online. And the government steps in and says, okay, our new floor price is twice that number, and you've got this deposit there. So all of a sudden your phone is ringing off the hook. And I think that's the case for a lot of companies in this space now, whose names we don't know, whose products we're unfamiliar with. But the government regulators who are trying to figure out what they're going to need to have a military industrial complex 10 years from now, they know those things, and they're getting ready to come out with floor prices that suddenly make a lot of these things viable. So it's a very exciting time, but a very complicated time. It depends on how ambitious you are, whether you're going to play this in one way or another.
Okay, but I like the term that you used, which is phase change, which is we are sort of in a different era than we were before, and a lot more becomes possible in this new era in this space. So I have some of the benefit of some of our private conversations. I'm going to try to pull some of that here into the public. And John, if you don't want me to, just tell me and we'll edit it out. But you gave a nod to a little bit earlier. So you are obviously long a lot of these assets that you're listing here, but you don't just play in or out. You also will use options sometimes as a hedge and sometimes as sort of a almost like a forced way for position sizing. So for a position that might have become a much larger percentage of your portfolio than you expected because it just appreciated so much. And correct me if I'm wrong here, but you will oftentimes use like covered calls with that asset, meaning, okay, if it just sort of hangs out where it is, it's generating income from me from the covered calls that expire. But if it goes higher, and it hits my strike price on my covered calls, yeah, it gets sold. I get the money for it and I get that appreciation up until the exercise price. But it also helps me because it's reducing my exposure to that position, which got a little bit too big in my portfolio anyway. So you kind of win almost no matter which way you do it. And I just want to lay this out for folks because it is more complicated than just simply, oh, I'm long this stock or I'm not. I also know at some points in time, although I'm pretty sure you don't recommend this for the average investor, you do short certain things. You've got some trends that you think might happen and you have some short positions on there. So I want to let folks know that this is a richer tapestry again than just simple, I'm long or I'm not. And of course, this is one reason why folks should subscribe to your Substack because you're pretty transparent about what you're doing here.
Yeah, we have a deal on the Substack newsletter that I own everything that's recommended in it, and then I say what I'm doing with it. If I sell something, I report that, and if I buy more, I report that. And yeah, a lot of people see bull markets sometimes put you in kind of a tricky situation because if let's say 2 years ago, you were buying junior silver miners, okay, and it was 20% of your portfolio, not to the point where it's risky or anything. Um, but then a bunch of those junior silver miners go up by 300 or 400%. And all of a sudden, silver related stuff is 75% of your
Hmm.
portfolio. So even though you love the concept, you want to stay with these equities, and maybe you love them, so you want to buy more. But it's probable that it's wise to rebalance your portfolio. Sell some of the thing that went way up, so that it doesn't present a huge risk to you if it goes back down. And there's a lot of people in that situation right now because the past year has been such a great run for commodities. So, generally, I tell people in the newsletter, don't you can't trade this market. So don't sell in order to get a cheaper price three weeks from now or something like that, because you can't do it.
Right.
It'll
Don't get cute
it'll
about
just
timing it. Yeah.
yeah, timing a market will destroy your self-confidence faster than almost anything else a human being can do. And so don't do that. But if you need to rebalance, there's lots of ways to do it. And writing a covered call on an appreciated stock is one way to do it. That's basically giving somebody else the right to call it away from you, or call some part of your portfolio away from you. And you get paid for that. So if the stock is going up a little bit at a time now after its huge run, and you sell a covered call on it, then you get paid to wait and see what happens. And if the stock goes up beyond the strike price of the option, then you get it called away from you. And there you go. You made your sale, you rebalanced a little bit, but you didn't have to make that decision. Somebody else made it for you. So
Hmm.
it's a little easier, because some of these stocks, they're very hard to sell, because once they've been behaving so well, it's like a really well-behaved family member or something like that. You just don't want to get rid of them. Yeah.
Right.
But if you write a covered call on it, somebody else makes that decision, and then you just wave goodbye, and that's it. And that in a bull market, that's one of the challenges, because when to buy is much easier than when to sell, as far
Hmm.
as emotional and intellectual decisions go. um, but when you reach a point when you should be rebalancing, there are tools for that. And you can also put stop loss orders in. So if something goes up and up and then starts to drop, you get taken out. Those aren't perfect, but they'll that's also a way to have somebody else make the decision for you. You put in the order, and your broker sells your stock for you. So um, this kind of a problem is the problem we all want, right? That we've got things that have gone up so much, our portfolio's out of balance now. And I would expect that to happen in this bull market over the next few years to a lot more people. So it's the kind of thing we should all be thinking about. Think about how you get out of some of these if they really take off, because that's something you need to think about. And it also is a fun thing to fantasize about. $200 silver. All right, what's my strategy going to be for when I
Yeah. High
when I get
quality
to that
problem.
point and
Yeah.
I need to sell it? Yeah.
If Michael Oliver is right about, several $100 silver by the
Mhm.
summer, a lot of people are going to have this high quality dilemma.
Mhm.
All right, so folks, just two practical things on that. So obviously, if you want to, look over John's shoulder and see what decisions he's making and how he is kind of building his overall investment process, right? Long options, shorting, whatever. You can subscribe to his newsletter. And if you'd like to get some customized help with your own portfolio around this, I highly recommend you talk to a good professional financial advisor who is well experienced in using options in the way in which we're talking about here. Obviously, a number of the ones that appear on this channel with me, the endorsed ones by Thoughtful Money, have this expertise, particularly the guys at New Harbor. Um, but yeah, don't. My advice is don't just try to learn this by the school of hard knocks on yourself. That can be very expensive. Leverage experts, whether it's following somebody like John specifically, or talking to one of these firms and having them come up with a customized plan for yourself. All right, John. So as we start to wrap up here, I've got one more kind of theme I want to talk through with you. But before I get to that, so this last one is just sort of about life enhancement. So you have, you're a successful investor. Um, you've had a good run, in your portfolio of late. You've also, and I won't get specific, but you've also had some pretty big curveballs that life has thrown your way over recent years that you've had to deal with. And one of the things that I really noted from our conversations while you're out here is you are getting to the stage where you're very excited about how much you still might be able to make given the market opportunity that we've been talking about here. But you're also keeping in mind that you're doing it for a reason. Like to me, you have a very good sense of what your why is right now in life. And you are, I think, getting really comfortable in trading money for things that are enhancing your life or your quality of life or what you want to get out of life, which of course is the overall goal with money, right? The mission for Thoughtful Money is to help people better fund their life goals, like to give them the information and hopefully the actionable solutions so that they can hit their life goals with more confidence and maybe a little bit sooner in life than they otherwise would be able to. The goal is not to die atop a big pile of cash. The goal is to die having lived a really rich life. And you've shared with me some of the things that you're doing where you're like, yeah, I'm actually happy to take some of the gains I've had and convert it into something in my life that is really bringing me a lot of joy or a lot of security or a lot of comfort, or it's part of a legacy I'm trying to leave. So I just wanted to give you a little bit of a chance to talk about your philosophy around that, because I think it's something that a lot of people should consider emulating or getting inspired by.
Well, yeah, money can be a lot of things, and I think the best thing that it can be for someone is that it gives you the ability to take your best instincts and create a life with them. And in my case, I have a couple of sons who money would help them a lot right now, and so um, I've spent basically a lifetime rolling the dice and placing bets in a lot of cases that some were good, some were bad, but I should have done more investing in the past instead of betting. But now I'm at the age where rolling the dice is absolutely not an option because when you reach a point where you can't really afford to have a big loss that lasts 10 years to come back. So
Sure.
you have to start shifting from growth oriented risky things into cash related stuff, and I'm doing that at the same time I'm exploring ways to help my kids. And yeah, the idea that at your death, everybody should be sitting around the lawyer's desk hearing what you decided to do with your money in your will. That's not a really good way to manage a lifetime of playing around in the stock market and saving. A better way is to help your family and your friends with the resources that you have available, with the idea that you take your last breath when the last dollar flows out of your account. That's the perfect way to do it. And I'm looking at strategies for a variant of that now at this point in life.
All right. Well, very well said. Well, John, look, thank you. Great conversation here. And again, thank you for the wonderful conversations that we had while you were up here visiting me. I hope we can do that again soon. Um, so most important question. So for folks that would like to follow you and your work between now and the next time you come on Thoughtful Money, where should they go?
I'm at rubino.substack.com, and it's a newsletter that covers what you and I talked about today, with some actionable advice thrown in.
All right. All right, folks. And John, when I edit this, I'll put up the URL to your Substack there. I'll also, folks, put it in the description below the video so you can get there with one click. And a couple quick things, folks. One, please join me in thanking John for joining us today and being so transparent with all of his expertise. Express that to him by hitting the like button and then clicking on the subscribe button below, as well as that little bell icon right next to it if you haven't clicked that already. And as I said earlier, if you want to get some help, so some customized help to help advise you on what you could or should be doing given your own personal financial situation, highly recommend you get that help from a good professional financial advisor, but importantly, one that takes into account everything that John's been talking about here for us. If you've got a good one who's doing that for you already, great. Stick with them. Don't mess with success. But if you don't, or you'd like a second opinion from one who meets that criteria, consider scheduling a free consultation with one of the firms that Thoughtful Money endorses. These are the firms you see with me in this channel week in and week out. To schedule one of those, just fill out the very short form at thoughtfulmoney.com. Only takes you a couple seconds to fill out the form. These consultations are totally free. There's no commitments involved. It's just a service they offer to be as helpful to as many people as possible. And if you are watching this video the day it launches, which will be Tuesday, I'm sad to report that you have just missed the deadline for the getting the lowest early bird discount price to the Thoughtful Money Conference. And folks, I have been banging that drum for like a month now. So if you didn't get it, I'm really sorry, but it's not for my lack of trying. But the conference is coming up in like 2 weeks. But this week, we'll be offering it at the last chance to save price. So you'll still be able to get it at a lower price than the full price it's going to rise to. So if you haven't bought your ticket yet, go run and buy it now at thoughtfulmoney.com/conference. And if you are a premium subscriber to our Substack, look at the emails I've sent you. I've sent you a code you can use to get an additional $50 off of that last chance to save price. As a reminder, the conference itself is Saturday, March 21st. Don't worry if you can't watch live. Everybody who buys a ticket will be sent replay videos of the full event, all the presentations, all the live Q&A. You'll get those replay videos within just a couple hours after the conference running. And just real quick to go through the faculty for you. If you haven't heard it already, it's kicking off with a keynote by the great Lacey Hunt. It's a graduate level presentation with some of the best charts you'll see on what's happening in the macro economy. He'll be followed by newcomers to our conference, Ed Dowd, Michael Oliver, journalist Matt Taibbi, Luke Roman, Brent Johnson, Michael Howell, Darius Dale, Judy Shelton, Danielle DiMartino Booth, Stephanie Pomboy, Grant Williams, Lynn Alden, Rick Rule, David Hay, Andy Scheckman, Melody Wright. I'm probably forgetting one or two there, but as you can see, folks, it's just a phenomenal roster there. So again, if you haven't bought your ticket yet, go buy it right now at thoughtfulmoney.com/conference and lock in that last chance to save price. John, my friend, it's again just such a joy. I guess just sort of parting question for you, just perspective-wise. For the folks that, a lot of the folks who watch this channel are just regular investors. We do have a lot of professional investors who watch, but a lot of them are just regular investors, kind of like you, who've worked really hard in their lives to amass wealth, to be able to take care of their family, be a good provider. And, I would say the majority of them are nearing retirement or already retired. And they're concerned about all the things we talked about at the beginning. They were very concerned about the decline in purchasing power of fiat currencies, and they're declined about the wild card of like, what could all these other things do? AI and some of the other stuff that we talked about. Any parting bits of advice for them about just staying sane and charting a course through this all?
Yeah, that is a big question now because it used to be that you could just, I had this kind of stock advice that I would give in interviews where I'd say just treat all this stuff like an investment thesis, okay, and look at the bright side of what you can make with your investments when all the crazy stuff starts happening.
Mm-hmm.
And that's psychologically a lot healthier, as a way of looking at the world.
Versus
I
just
think
focusing on the doomerism part of it.
yeah, instead of just curling up in a ball and whimpering because a talking head online told you the world was ending, think, well, okay, how can I exploit that? How can I invest in it to make money at the other end of it? Now, it's almost better just to cut yourself loose from a lot of this stuff. I mean, so much of it is beyond our control, and so much of it is kind of dark and potentially scary that I think the best advice that anybody can give most people now is just to disconnect. Just don't pay attention for days at a time because we can't fix any of this stuff. And if you're already set up pretty well with your investments and everything and don't need any kind of market signals, just go work in your garden, go take a walk on a path along Lake Tahoe or something like what we did. We for that 2 hours that we were out there with your dogs at Lake Tahoe, neither one of us cared about what the stock market was doing or what
Yeah, we
soil
didn't
was
check our
doing.
phones. Yeah,
No, not at all. And the more time like that you can build into your life right now, I think the healthier you will be. And then this stuff that happens is going to happen. It's going to play out the way it plays out. And we'll just have to be as resilient as possible when the time comes.
very, very well said. Can't think of a better way to conclude this. John, thanks so much, my friend. Again, appreciate everything, all the time coming on here, the friendship, etc. Again, I hope I get to see you in person again sometime soon. But thanks for being just giving it all to today's listeners.
Thanks, Adam. Look forward to the next time.
All right, same here. Everybody else, thanks so much for watching.
What percentage of gold backing the rest of the Fed's balance sheet would make the rest of the treasuries trustworthy to hold for people. And if we go to the 1980 numbers, it's something like $40,000 to $50,000. If we are to equate the dollar value of those 235 million ounces to the rest of the pile on the balance sheet, which is the monetary base, it would have to be 30 to, I think it's about 50,000, or it could be 55,000, somewhere around there, like between 40 and 50 or something like that. It doesn't really make a difference. But that's what we're talking about. I'm not talking about covering M2. I don't think we're going to get there because to cover M2 is what, like 21 trillion, whereas the monetary base is like 5.6 trillion. It had to be 4 times that. I don't think we're going to see $200,000 gold. I think the dollar's going to break before that.
In 1980, the market drove gold higher because investors no longer trusted the Fed's debt-heavy balance sheet. Gold rose enough to fully back that debt, restoring confidence. Applying the same logic today, with the Fed holding about 235 million ounces of gold against a $5.6 trillion monetary base, gold would need to reach roughly $40,000 to $50,000 an ounce. Covering the broader money supply would imply $200,000 gold. Rafi doubts it will reach that point, expecting the dollar to collapse first. Rafi Farber is a financial writer, investor, and commentator often referred to as the endgame investor. He explains that gold is real money, and when its price changes, it's not gold being revalued, it's the dollar. History shows 2 forms of revaluation: statutory, like in 1933 when FDR raised gold's price from $21 to $35, fueling inflation, and market-driven, like in 1980 when distrust in the Fed's balance sheet drove gold up to around $850. Both have the same effect, shifting the value of the dollar, just through different forces. A recent Federal Reserve analysis into gold revaluation mirrors a broader concern over the dollar's stability. While not signaling immediate policy action, it underscores the extent of fiscal stress. These discussions signal deeper doubts about the sustainability of fiat frameworks. Today, stresses in the dollar system are showing up again in the gold futures market, where spreads across maturities resemble those seen in the 2008 and 2020 crises. This suggests another monetary breakdown may be near. While the timeline is uncertain, the underlying truth remains: gold is money, and its role as the ultimate measure of value won't change no matter how the dollar performs. As we present clips from the video, please like this video, subscribe to our channel, and turn on the notification bell to stay instantly notified every time we upload a new video. Thanks for the support, and enjoy the video.
What it means that gold is the money. If the gold is the money, then every time the price of gold moves, it's revaluing the dollar. Gold doesn't actually get revalued. The dollar is being revalued. Now the question is, are we talking about statutory revaluation or market-based revaluation? You just cited 2 examples, one being 1933, which was statutory, right? FDR just decided, maybe on some advisement, maybe on a whim. I read when I was turning libertarian when I was younger, but he was talking about, I think in his book, Broke, how FDR just decided on a whim to make it 35. I don't know, he was just like flipping numbers in his head and he decided that was the one. Could be true, I don't know. And then you were talking about the revaluation in 1980, where the price of gold in the market that you could get a gold coin for to shop was what was being revalued, and that hit 872 or 850, wherever you want to count the top. And ultimately, these are really the same thing. right? They're brought about in different ways, and that's but they are monetarily speaking, what is happening in the monetary system, it's the same thing. It just the difference is who's acting upon it. Like if a 50 kilogram weight drops on your head, you're not going to really care that much if it was, like, say, a meteor from God, or let's say somebody had sinister would drop something on your head from 100 feet above you, or drop the piano on you. Either way, you're dead. It doesn't make a difference. So I don't think we're going to have a statutory gold revaluation. And what happens during a statutory gold revaluation? Well, you look at the price inflation statistics, which we have from the 1930s. And in April 1933, I think the deflationary, and I'm talking about consumer prices, the deflationary statistics were something like -9% a year. And then by about 10 to 12 months after the revaluation from 21 to 35, price inflation shot up to positive 10, 15% or something like that, like a huge move. And really that was the point, because by revaluing, that gave FDR's government, or the Fed under him or beside him or whatever, the ability to print more money based on that gold revaluation, and then the inflation came from there. If there are problems with the dollar, then what you would see is spot gold going pretty high relative to other maturities, but going out into the future I think you would compress in the middle, and then the price would go higher out into the future, because you'd have speculators that are also worried about the dollar, because they want to, they're using gold to speculate because they see something wrong with the dollar. But also you have the people at the mouth of the pipe, the big banks, and they are going after spot gold itself. So you're having these like kind of zigzaggy, wavy maturity scheme. And I think that's what's happening now. But you'd have to look at a chart of this. It's available on Gold Charts or us to see all the maturities and the different colors of the lines, and they get wider as we get closer to a crisis. So the chart goes back to, I think, 2005, 2006. The only time I've seen the maturities be this spread out are 2008, 2020, and now. So the question is it happening again? And there are other signs that corroborate it. How far out are we? I don't think we're very far. People say, like, I've been around since 2020 saying the same stuff, but it's 2025. Even 5 years is not that much time. I know that's kind of a cop-out, but it's also true, and gold is still money. I mean, it doesn't really matter, because I know what the truth is. People can say what they want, but the reality is reality. It's not going to change.
Rafi thinks that the financial system is like a giant pyramid with gold at the base and countless layers of debt and derivatives stacked on top. Nothing can replace this structure. According to BIS, proposals like the stablecoins can boost liquidity and payment efficiency, but they don't fix the financial system's core weaknesses. They only add another fragile layer. Their heavy reliance on U.S. Treasuries exposes markets to volatility, where sudden redemptions could spark liquidity shocks. Even with new rules like the Genius Act, critics argue regulation creates only an illusion of safety while deeper risks remain. Eventually, a crisis will force people holding stablecoins to convert them back into cash, triggering a rush for dollars. At that point, the Fed will have to step in and monetize debt as always, because the underlying pyramid hasn't gone away. These measures may provide short-term liquidity, but in reality, they make the structure even weaker, like stacking jello on top of bricks. One small shock, and the whole thing risks collapse. Now let's review the interview.
No, it's not going to replace anything. We're on a pyramid. The pyramid begins with gold, goes up derivative layer by derivative layer to where we are now. And there's a lot of derivative layers, and you can argue about what layer is which layer and where is it in the pyramid and all this stuff, and it's very complex. But there's no getting out of this pyramid without it either falling over or building a new layer that looks new, but it's really based on everything that's on before. Right? All you can do is build one more layer. So if they do this Genius Act and stable coins, and obviously there are serious threats to personal liberty involved with stable coins. Fine, I don't dispute that at all, and I know that the government wants to take as much liberty as they can from us, reasonably as much as they can reasonably get away with. They tried taking away almost all of it in COVID. There was backlash, and Trump got reelected. I'm really oversimplifying, I know, but I don't have time to get into geopolitics here or anything like that. But what the Stable Coin Act or the Genius Act, whatever they're calling it, can do is it can turn T-bills into a more liquid asset by making them tradable. If people are going to take stable coins as settlement for payment, then it turns T-bills into basically dollars. So the Fed wouldn't have to monetize that debt as quickly, theoretically. But sooner or later there's going to be a crisis anyway, and then everyone with stable coins is going to they're going to need cash, so they're going to have to sell out of their stable coins to get dollars, and there's going to be a rush on dollars, and then Fed's going to have to monetize it anyway because all of this pyramid is still there, and all prices from today are still based on yesterday. No matter what the hell you do, there's no getting out of that ever. Just like there's no breaking the law of gravity, you cannot fly without counteracting gravity with an opposite force pushing down. It's not possible. So at that time when suddenly there's a dollar crunch and everyone has to get out of their stable coins to pay their bills, right? Then the Fed's going to have to take those T-bills, turn them into dollars by buying the T-bills, giving dollars to whoever needs to give dollars to whoever has the stable coins. We're going to be in the same place we are now. So the most this can do is provide a little bit more liquidity on the top of the pyramid. But like, I guess an analogy would be like instead of like a really heavy brick on the top, right, on the top layer, you'd put, let's say, I don't know, something a little more jiggly, maybe like Jello on the top. So you can build it higher, but it's like a lot weaker, and like a little bit of sun can melt it and then it just falls over anyway. That's the analogy that just came to my head, Jello.
History shows that whenever trust in the dollar erodes, gold steps in as the ultimate anchor of value. Whether through statutory moves like FDR's revaluation or market-driven surges like in 1980, the effect is the same. The dollar weakens, and gold reasserts its role as real money. Today's fragile financial pyramid, propped up by layers of debt and experiments like stablecoins, cannot escape this reality. As stresses build and liquidity games run their course, gold remains the foundation that cannot be replaced, only rediscovered when confidence in paper assets fades. If gold does climb toward $40,000 an ounce, how might this reshape global financial markets and investor behavior? Could stablecoins and digital assets delay a monetary crisis, or do they simply make the eventual collapse sharper? Please leave a remark in the section below with your ideas. Please remember to subscribe to receive updates, and if you find this helpful content, kindly give it a thumbs up. We are grateful that you joined us on this journey.
Most of it is leaving the COMEX, which is also very unusual. It's not going into the eligible category in the COMEX, it's leaving. So it's called a loadout. We're seeing massive deliveries and a lot leaving. Who's doing this? Same thing is true here in the West, where 40 plus central banks have pulled their gold out of the New York Federal Reserve, which would for 50 years give access to COMEX, and pulled their gold out of the Bank of England, which would give access to the LBMA. So they're taking physical possession, removing counterparty risk. So anyways, we see all this gold being delivered. Say several things that are provocative or certainly interesting, and that is he's a self-proclaimed gold bug. He said things such as, I want to remonetize the asset side of the balance sheet for the U.S. government. Now, he backed off saying it's not gold, but I'm thinking he's going to remonetize gold.
Physical gold deliveries have increased significantly, according to recent COMEX statistics, with warehouse stockpiles dropping from 45.1 million ounces in early April 2025 to 43.6 million ounces by mid-April, a $4.8 billion decrease. 8 days in a row, traders have been repatriating metal, some of them back to London, as a result of the reduction of U.S. import tariffs on gold. This is the first such run in 14 months. Demand is being driven by trade disputes, slowdown fears, and global tensions. Persistent drops in COMEX stocks may indicate a physical scarcity and lead to a price increase. Treasury Secretary Scott Bessent stated on February 3, 2025, that the United States intends to monetize the asset side of its balance sheet in less than a year. Although a revaluation of gold is not currently being considered, expert Andy Scheckman thinks it might eventually entail remonetizing gold. Highlights that global trade tensions, particularly US-China tariff wars, have rattled markets. Gold, a classic safe haven asset, is seeing increased interest as investors hedge against economic instability. The Moody's downgrade of the U.S. credit rating in May 2025 further fueled this trend. China's gold market is heating up, with speculators and central banks boosting demand. Reports suggest Chinese investors are diversifying away from U.S. dollar assets, and physical gold is a prime beneficiary. Earlier this year, fears of U.S. tariffs on gold imports prompted traders to stockpile bullion in COMEX warehouses. Now, with some tariff exemptions like those for Switzerland, gold is flowing back out, tightening U.S. supplies. Moreover, China has moved forward independently, rebranding the project as BRICS Bridge. This new version is already fully connected with 11 Southeast Asian countries and 5 Middle Eastern nations, collectively representing 38% of global GDP. The 17th BRICS summit held in Brazil's Rio de Janeiro has come to an end. The one big takeaway from the annual summit was that the leaders of the BRICS countries have decided to move forward on implementing a cross-border payment system, the main global interbank payment network. Gold remains central to the plan, signaling a shift toward a settlement system less dependent on the Western financial framework. We're about to explore the video, but first, subscribe and hit the bell icon to keep up with our newest uploads. Your feedback in the comments is always appreciated.
I think gold is becoming central to a new system. Call it the skeletal system of a new monetary order, whether it be in the BRICS or whether it be in the United States. Last year, the Bank of International Settlements pulled out of Project Enbridge at the 12th hour. They had been developing it with the Bank of International Settlements Innovation Hub with China, Hong Kong, Thailand, and the United Arab Emirates. And the Enbridge technology is a cross-border payment system that allows for instant settlement, 7 seconds, a 98% reduction in fees, cross-border between central bank digital currencies from country to country, free from SWIFT intervention. And the 5th participant in the Enbridge technology is Saudi Arabia. And things were progressing to the point where Dilma Rousseff, the former president of Brazil and the head of the New Development Bank, the BRICS New Development Bank, said, we've agreed in principle to a new settlement system called the unit. It is a digital representation of a basket of 60% BRICS plus currencies and 40% gold, deliverable upon request. And things were progressing, and you could see that gold was becoming central to their theme. And we've agreed upon it in principle, she said. We're ready to roll it out over Enbridge, which is operational. And at the 12th hour, in what amounts to espionage, James Bond movie, the BIS, which is a Western institution, pulled out and said, we're pulling the plug on Enbridge. We can't, and mind you, this is largely a Chinese technology, although through the Innovation Hub it was refined, and thoughts of rolling it into the Western system as well. And they say we can't be involved in any platform that will allow countries to sidestep Western sanctions. And so they pulled out. Now it's as if they just realized that Russia was the R in BRICS. And then things went very quiet. Now, since then, we've seen some very, very significant things that I think are largely being ignored by the West. And in particular, the new Bridge, let's call it repackaging, it's called BRICS Bridge. And BRICS Bridge has now been rolled out officially by China. And they're calling it the renminbi cross-border payment system, first and foremost. So what I believe is happening is because Trump is putting so much pressure on the BRICS, they're kind of stepping out for a second, maybe waiting him out and letting China take the lead in developing the rails of this new system. And China came out about 3 or 4 weeks ago and said, and I've talked a lot about this, that, hey, we have connected with the new bridge technology, fully connected and integrated, 11 Asian countries, ASEAN, these are the countries from Southeast Asia, and 5 Middle Eastern countries. This represents 38% of global GDP.
Russian Foreign Minister Sergei Lavrov confirmed that several initiatives are underway within the BRICS framework to develop alternative, independent payment platforms. Crucially, he stated that countries outside BRICS will also be able to access these systems once established. At the BRICS outreach session, there is an ongoing work to create a cross-border payment and settlement infrastructure. And he emphasized the drive to build a more stable global economic architecture, anchored in multipolarity, where trust in Western-dominated institutions is diminishing. BRICS countries, he noted, are positioning themselves as key drivers of this transformation. The Shanghai Gold Exchange, SGE, officially launched its first offshore, international board-certified gold delivery vault in Hong Kong, and he believes this marks a major milestone in facilitating RMB-denominated gold trading and attracting global investors seeking physical delivery in a stable jurisdiction. While the Hong Kong vault is now operational, no confirmed updates yet on vaults in Saudi Arabia, under construction, Moscow, St. Petersburg, Dubai, or elsewhere along the Belt and Road are publicly available. These remain future objectives in China's broader strategy to build a decentralized, resilient gold settlement infrastructure. The new Hong Kong vault, operated by Bank of China, Hong Kong, enables RMB-denominated gold trading with cash or physical settlement. Analysts see the launch, along with 2 yuan-denominated gold products, as a major step in Beijing and Hong Kong's push to expand global commodities trading and potentially erode Western monetary dominance. Let's revise the interview.
You had Sergei Lavrov, who was in meetings with Dilma Rousseff the year before, when they both came out of the meeting, said, we've agreed in principle to this new settlement system called the unit. He's been closely involved in all of the BRICS meetings since day one. And a lot of the technology or a lot of the ideas, the infrastructure of how they would roll things out were his. So in any case, he comes out and says, we're going to issue this BRICS technology, this cross-border payment system. We're going to issue it to non-BRICS members, not just the BRICS. A lot of the pushback with the BRICS has been they're not big enough. When he said that, after they had already connected the Asian countries, it became very obvious that this is bigger than people are thinking. And I said publicly they're going to roll it out to the Belt Road Initiative, which it appears they now are. So what I'm getting at is that this system, which would compete with the SWIFT, will settle in 7 seconds, not the 3 to 5 days it would take these countries to go back and forth from dollars, from their currency to dollars and the other currency, and back and forth at a 98% reduction in fees. And they're going to open it to the remainder of the world. It's just not compatible with the pound, the euro, or the dollar. Subsequently, BRICS Pay is also being rolled out to the Belt Road Initiative, which is 75% of human population, 50% of global GDP. This is the cross-border business to business, consumer to business, small bank to small bank, the retail side of BRICS' agenda. Again, China is doing the central bank side. They're calling it the renminbi cross-border payment system, but it is the BRICS bridge. It is the M-Bridge technology. But rather than antagonize the president, they're letting China do it first. The key to the third piece of this puzzle, the key to it all, at the same time, we get the expansion of the Shanghai Gold Exchange into multi-jurisdictional vaults around the Belt Road, starting with Hong Kong. The vault is complete. The next one is Saudi Arabia, which is under construction now. The idea between all of this is to allow countries to trade cross-border with one another in their own central bank digital currencies. We already have 16 countries officially signed up outside the BRICS, the Asian countries and the Middle Eastern countries, and to settle imbalances in gold through a series of multi-jurisdictional vaults, whether it be the expansion of the Shanghai Metals Exchange, Hong Kong, which is operational. And by the way, the yuan is immediately convertible into gold, not having to first convert to dollars as you would have in the past. So they're saying, okay, China will trade with Saudi Arabia. They'll send them digital yuan for their oil. Saudi Arabia can then immediately convert that into gold if they wish. Right now in Hong Kong, soon to be in their own country, in these vaults as they expand through the Belt Road, very ambitious endeavor, but ultimately connecting to a whole series of vaulting networks, whether it be in Moscow, in St. Petersburg, in Dubai, the new BRICS Gold Exchange, Shanghai, and the vaults that we see throughout the world. It enables these countries to trade locally in 7 seconds, boosting their own monetary infrastructure, free from SWIFT intervention, and settle any and all imbalances in gold. It's genius. It truly is. And I really hammered this home over the last month. And then yesterday we get an article, or 2 days ago, from Forbes that pointed out that China is now just the third largest trading partner for the United States. And in May, their numbers were less than 6% of trade, which is the lowest level, Daryl, in over 20 years. And the article went on to say that the Asian countries, these same countries that are now hooked up and actually in operation with the new bridge technology, together have a population twice as large as the United States, over 700 million people. They have the fastest growing consumer markets in the world, the fastest growing middle class in the world. And as a group, get this, these countries are now China's largest trading partner by far, way ahead of the EU and the United States. Let me just say that once again. They're connected, and they're the largest trading partner of of China, and they can trade cross-border in 7 seconds with no SWIFT interference, no SWIFT recognition. They won't know what's going on, and any imbalances will be able to be settled immediately in gold. This is a massive deal for the BRICS. All right, so that more or less covers the BRICS side of things, where you have, in essence, an expansion of the Shanghai Metals Exchange, connecting with other metals exchanges already in operation in Dubai and in Moscow, the new one that just was built in St. Petersburg. And the ambitious goal over the next year or two is to create this skeletal system of vaults, multi-jurisdictional, so it's not all held in one location like the Bank of England, who had the power to say to Venezuela, yeah, we're not going to give you your gold, thanks anyway, move along. So you want to be able to keep gold in various jurisdictions to mitigate any risk, and then be able to settle imbalances through trade through this entire network. It's important to remember that the Belt Road Initiative, these countries are not in the BRICS, nor is the Shanghai Cooperation Organization, the largest regional military and financial group in the world, or the Eurasian Economic Union, all the countries that end in STAN, a Russian endeavor like Kazakhstan. These countries are all very, very, very connected to the BRICS. In fact, the president of Belarus has been screaming forever that the Shanghai Cooperation Organization, the Eurasian Economic Union, should meld with BRICS. The Belt Road countries, 150 plus countries, 75% of human population, 50% of global GDP. They're not in the BRICS, but they are very connected with the BRICS.
A changing global financial order is indicated by rising physical gold demand, COMEX outflows, and strategic actions by China and BRICS. Gold is recovering its monetary significance as the United States deals with trade conflicts, credit downgrades, and possible balance sheet monetization. a shift towards settlement methods less dependent on the dollar, and SWIFT is indicated by China's offshore gold infrastructure and BRICS-led payment systems. With gold at the center of a new trust-based economic structure, this multipolar movement has the potential to revolutionize international trade. Will the BRICS gold-based payment systems hasten the demise of the US dollar as the world's dominant currency? What effect would persistent COMEX gold outflows have on world gold prices over the upcoming year? Let us know your thoughts in the comments. If you enjoyed this video, give it a like and subscribe for more updates. Thanks for joining us on this journey.
Clearly in Asia, particularly in China, they view it as money. And of course the BRICS, and that's one of my biggest bullish factors for gold, is I saw the de-dollarization and countries moving away from the United States economically and from their currency as bullish for gold. So that would argue that I still think it has to go a lot higher over time, but I think a reasonable target of 4,000. I think it's been accumulated. It's still probably 12 to 24 months away before they officially come out and say, okay, this is how we're going to trade among ourselves. And part of that is going to be gold. People who are going to talk about, oh, the Hunt brothers and once went to 50, well, to get back to that, you're right. It's almost going to have to trade at 200 for inflation. So what I have said, and it probably throws me into the silver bug camps completely, is that triple-digit price of silver is a legitimate target.
In Asia, especially China, gold is still seen as real money, and that perspective is spreading among BRICS nations as they move away from reliance on the US dollar, a trend that strongly supports higher gold prices. China's central bank continues buying gold. In August 2025, it purchased about 2 tons. BRICS nations are developing alternatives to dollar-based financial infrastructure, including digital payment systems and local currency trade. Gold is increasingly seen as a neutral reserve asset among these countries. Given these shifts, a long-term target of $4,000 for gold looks reasonable. Silver also has enormous potential. Adjusted for inflation, its 1980 peak near $50 would be closer to $200 today, making triple-digit silver a realistic and justified goal. Peter Grandich, a veteran market analyst and financial commentator, recalls that back in the 1970s and early 80s, few believed the Dow could ever reach 3,600, let alone 36,000, but history proved otherwise, just as today many doubt gold's ability to climb much higher. The reality is that fundamentals for gold have never been stronger. De-dollarization is accelerating across Asia and the global south, with central banks and retail investors boosting gold purchases and trade in local currencies rising. BRICS nations are building alternatives to dollar-based systems, and gold is increasingly viewed as a neutral reserve asset. China continues steady gold accumulation, though its reserves remain low compared to its economic size, leaving room for much more buying. Analysts expect this sustained demand to lift gold's floor higher, with BRICS discussions of gold-linked trade further supporting long-term price growth. BRICS nations are exploring dollar-free trade, with gold discussed as a potential benchmark or backing asset, though no unified gold-backed currency exists yet. Rising central bank demand, especially in Asia, is lifting gold's price floor, while silver also shows huge upside, with inflation-adjusted targets pointing to triple digits. As we start the video, don't forget to hit the bell icon and subscribe so you don't miss any updates. Please give us a thumbs up and leave a comment below if you enjoyed the article. We value your opinions.
For 13 years, the Dow only traded between 700 and 1,000. In fact, the very famous Business Week front page said equities are dead. Wall Street was extremely bearish. And an unknown young man came out of Gainesville, Georgia, named Robert Prechter Jr., with a philosophy and a technical analysis no one really knew of, Elliott wave theory, and said the Dow's going to 3,600. And they just prosecuted him to call him every name in the book. And then when the market took off, he became popular. And then he made a call about the crash in 87 along with me. And the perception was, how could it possibly go to 3,600, let alone a few decades later, 36,000 and more? So that same feeling's in gold right now. People, especially people that have been bullish and profiting from it, this 36, this is way out of line. Yeah, it's great. It give you all the reason, but how could it go a lot higher? It's not possible. You have to take that same philosophy. There's no reason it can't. In fact, I would argue it's not cheap anymore. Someone that was buying it at 1,300, seeing the tripling. But the fundamental argument for gold has never been better. We had at one time suppression by central banks who were offloading it. Now they're the biggest buyers. We had clearly not any society thinking it was money. Clearly in Asia, particularly in China, they view it as money. And of course the BRICS, and that's one of my biggest bullish factors for gold, is I saw the de-dollarization and countries moving away from the United States economically and from their currency as bullish for gold. So I think the more important way to answer your question is not talk about some of the general stuff or inflation or even against the stock market, is to admire how it's performed in an environment wasn't as conducive as it is now. So that would argue that I still think it has to go a lot higher over time, but I think a reasonable target of 4,000. And remember, when you're in all-time highs, other than a psychological number, there's no real resistance. So, pick 4,000. Yeah, that'll be a round number and so forth. And, Wall Street has treated gold like kryptonite. I think 0.5% of portfolios are assumed to have some exposure to gold. Can you imagine if people just went to 1 or 2%? It's still a very, very viable market for the long term. Well, I think it's going to play a significant role in the BRICS. They have not acquired all of this gold as a trade or a personal investment. They certainly can't flip it to someone that's going to pay even more so they profit from it. I think it's been accumulated. It's still probably 12 to 24 months away before they officially come out and say, okay, this is how we're going to trade among ourselves. And part of that is going to be gold. I don't think there's a worldwide situation coming anytime soon, because I think things have to get a lot worse before people realize how messed up we been with fiat currencies. I do still think that one of the ways that they're only going to be able to sell treasury bonds, especially long dated ones, a year from now, because I'm a big believer that short rates can fall, but long rates are only going to go higher. I think that's going to find a way that the Trump administration could reprice its gold that it owns to whatever the current price is, and also introduce longer term 40 or 50-year bonds with some sort of gold backing in order to get people to buy it. I think that's going to be how difficult it's going to come for the United States to fund itself, while other world bond markets, as we speak, are imploding as well. 180, and it was profitable to treat it as the second-class citizen to gold. But earlier this year, when it dipped under 30, when I looked at the fundamental argument, it was never stronger in the 41 years I've been involved. So I became a silver bug. And I also said it probably would lead gold for quite some time to come. And I think that's happening here. I think you make an excellent observation. People who are going to talk about, the Hunt brothers and once went to 50, well, to get back to that, you're right. It's almost going to have to trade at 200 for inflation. So what I have said, and it probably throws me into the silver bug camps completely, is that triple digit price of silver is a legitimate target. First of all, it's not that much more than a double from here. It sounds like a lot because for a lot of years it was single digits, low price. But I think it has every reason to continue to rise with gold. And the competition for it, the stock market, I have to throw this in. I made a big change a couple of weeks ago. I was not in the stock market crash camp. My January forecast for our clients was the stock market was going to be either side of unchanged. I told people to avoid U.S. equities, get into world funds. I love the Chinese market. But a couple of weeks ago, stuff just screamed that we were very vulnerable to a hard fall or even a crash. And that has been competition to gold and silver, and also cryptocurrencies. And so a lessening of the bull move or an actual decline, as long as it's not a total crash, could only aid the gold and silver. You know how I know that, Jesse? I left the metals and mining industry as a main place of business for myself in 2013. I dipped myself back in 5 years ago when I got very aggressive in gold and mining stocks and all. But I'm hearing from people in the last few weeks that I haven't heard from in 10 or 20 years and saying, hey, I was looking up metals and I saw your name. I thought you left the business. And then, of course, the follow-up question is all the same. So what do you like? And I think we're just at that stage now where, other than that little audience that always confined ourselves to, we used to call ourselves the hard asset crowd. I don't think we say that anymore. It's being broadened out to generalists. And I think that's going to bode to help the metal prices higher.
Peter mentions that the mainstream U.S. financial media won't highlight gold and silver because of their ties to Wall Street. But once public demand grows, that will change. Major gold producers are already generating huge cash flow and could see much more interest as generalist investors notice their outperformance. The largest gold miners reported record free cash flows, revenues, and profits in Q2 2025. Margins are very strong. However, production has fallen for some majors. Juniors are expected to outperform seniors in this cycle due to high leverage and exposure in exploration and resource discovery. Established miners are expected to continue reporting strong cash flows, using capital for dividends, buybacks, and to shore up balance sheets. Despite strong gold price performance, analysts, including Peter, believe gold stocks are lagging and undervalued relative to gold itself. Analysts are watching for better leverage to gold, and many see additional upside as investor attention and valuations catch up. Let's dive into the interview.
Well, much of the mainstream financial media in the U.S. is tied to the hips of the financial service community. They're not going to write things go against it. They're advertisers, you know. So I never expect them to write glowing stories about that, because gold and silver have been treated like kryptonite since I've been in the business by the financial service industry. And I don't expect that to change until the public overrides that demand and says, hey, listen, I'm listening, or I got this neighbor and they're killing it, and blah, yada, 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 yada. And so that's when I think the public will come to it. The mining stocks, even the exploration, and they're two different species, and I'll address them both. The mining stocks, as I said earlier, when I originally sold some of my physical gold in the beginning of the year at 3,500 to buy the major gold producers, which greatly outperformed the performance of the physical gold, they have many quarters ahead of just unbelievable, legitimate printing money through free cash flow. And what will happen for them and what will keep that sustained for them is, as we peter out in the stock market here, and we're seeing a lot of companies now not meeting the low-end earnings estimates so they can always say they beat them, these generalist money managers are going to hear about these mining companies. Look at Newmont Mining. Maybe today, as you and I record, depending on if Palantir gets hit enough and Newmont is rising, it's going to be the best performing stock in the S&P 500. Right now, it's number 2. And so that means it's outperforming 498 other general equity stocks. And yet, I would tell you that if we looked at people's portfolio, not half of 1% have Newmont Mining in it. So there's still so much upside demand for mining shares, and they should do well. But where I went to, and it's the most riskiest and speculative end of it, and remember, Wall Street created the word speculating, so don't really call it what it really is, and that's gambling, where you have to be mentally and financially prepared to lose part of all your capital. But the juniors is really where we're going to see a really bang for the buck. We're already seeing that in some incidents. And the reason is the world has not only shrunk to where companies can go and without too much risk and try to find the metals that are so critically needed now, everybody realizes, but the amount of money that has not gone into that industry to find these things. And remember, even if you hit it tomorrow, that you just went to a rock and drilled and it doesn't work that way, it takes several years of exploration and all. It's probably anywhere minimum, depending where in the world, 10 to 15 years before it comes out and pours the first metal and all. So when that recognition is realized by everybody and everybody realizes how we're scrambling, you know, a gentleman made a good point to me the other day, and it was Sam Lee, one of the It's actually the largest stock that I own, North Isle Copper and Gold. And he was just on a trade mission for Canada to Korea, South Korea, and Japan. And he made a very good point is, even though they're world renowned for producing so much of the stuff we need, technology stuff, appliances and all of that, their entire base of metals that they need is from outside their country. They don't have any real own supply of their own. So here we have the world is scrambling for critical minerals and all. There's not been a lot of money put in them. I think that's going to make exploration companies become darlings for a period of time. And the majors, their currency is so strong now because of their stock, they're not going to try organic growth. They're just going to go out and buy because we're still seeing good deposits selling for as little as $20 an ounce with gold at 3,600 and going higher. So to answer your question, I'm sorry for being long-winded, but I just think the mining shares and the exploration stocks, their day in the sun to where everybody's seeing it hasn't even arrived yet.
Metals and miners are poised for a solid next run higher, with fundamentals stronger than ever. Will the formalization of a gold-linked trade system by BRICS eventually hasten the move away from the US dollar? Is it possible that cheap mining stocks may eventually overtake gold's performance and produce disproportionate returns in the upcoming cycle? If you enjoyed the content, please like this video, subscribe to the channel, and press the bell icon for timely updates. We appreciate your support, and thank you for being with us.